Let's digest what happened last week at the Federal Open Market Committee meeting with the Federal Reserve on this week's Video Market Update. The Federal Reserve met last week and announced a 25 basis point or quarter point increase to interest rates, specifically on the federal funds rate. So the Fed funds rate is the rate in which banks charge each other to borrow money from each other overnight. So the Fed funds rate is a rate that you can or could see change a few interest rates, like credit cards. The interest rates could go up on credit cards, on private student loans, probably not government, but private student loans. You may see indexed annuity rates go up. You may see savings rates and CD rates go up eventually. Generally, those go up, not necessarily when interest rates go up, but as there's demand by the banks to have an increase of capital. So that's one way that we can be sensitive to it. Home mortgage rates are actually tied to the 10-year Treasury, the London Interbank Offer Rate, or the LIBOR, or the mortgage-backed securities market. So this interest rate is not going to directly impact mortgage rates, as we've seen those rise about a point in the last month or two. One of the things that they did signal is that interest rates are going to rise at each of the next successive 6 or 7 meetings at a quarter point. So unless something were to change, we're going to continually see a rise of interest rates. Now, some people think that the Federal Reserve should be acting faster, raising interest rates at a half point or an entire point. What the Federal Reserve is trying to do is orchestrate what's referred to as a soft landing. Now, if you've ever been on an airplane, you know the difference between a hard landing, where it feels like the pilot's bouncing you off of the runway, and a soft landing where you almost don't realize that you even landed the plane. A soft landing that the Federal Reserve is trying to do is say, they're more worried about inflation. So they're willing to slow the growth of the economy in hopes that by slowing the growth of the economy and raising interest rates, it will slow and bring down inflation. If that were to happen, we would see nominal economic slowdown. We'd see nominal interest rate hikes, and eventually we can adjust to those, but we would see inflation come down, which is essentially a hidden tax on pretty much everyone. But what if they can't maneuver a soft landing? Interest rates go up, inflation stays frustratingly and stubbornly high, but the economy slows to a point of recession. And that's the fear of attempting a soft landing and instead just saying, take our medicine today, it's going to hurt, it's going to be painful. The Federal Reserve saying, we want to give you medicine, but we don't want it to hurt, and we think we can orchestrate a soft landing. I'm somewhat optimistic that they can actually do that. The consequences of them being unable to do it, again, could be recession, which we would probably see till the end of this year or the beginning of next. So if you have any questions on anything that came out of the Federal Open Market Committee meeting or the rise of interest rates, please let me know. If not, I hope you make it a great week.